Abdullah Karatash, you see him right there, is with us, here with us to provide his perspective. He's head of U.S. fixed income trading at the French bank Nataxis. Abdullah, good morning to you. Welcome. Good to have you here on the Inside Track. What do you think? Is Joseph Ackerman correct? Are we looking at the kind of market situation that we faced back in 2008? We didn't know what would happen when and if Lehman Brothers finally went bankrupt. It did. We soon found out, and one wonders whether we're going to find out something similar once something happens, whether it's in Europe or whether it's here.
Eric, it definitely feels a lot like late 2008. What we saw in 2008 was the bond markets, the corporate bond markets specifically, were selling off and signaling that there was something awry going on, where stocks were buoyant, remained buoyant, right up until Lehman went down. And we're, it's a very
So you see similar conditions now?
Absolutely, absolutely.
Okay, well, as far as,
this is an awfully, bearish tone that you're setting for the conversation, and I just want to dig into that for just a moment.
Sure.
What I want to know, and I think what everybody else wants to know, is do you really believe that we are on the cusp, on the precipice of something like what we saw take place, what was it, September the 17th of 2008, after Lehman Brothers filed for its bankruptcy, that the credit markets became almost instantaneously frozen, that short-term funding for just about anybody dried up, whether it's the banks or the corporates? Is that what the fall of 2011 looks like to you?
I think we're in for a very wild roller coaster ride. And whether or not it plays out exactly like it played out in 2008, that remains to be seen. There will be federal intervention, both on the European front with the ECB and in the U.S., but it definitely doesn't feel healthy. Europe's sovereign debt woes aren't going to go away overnight. These are really, it's a banking problem at heart.
One thing we should point out is we have seen the cost for investors to protect against that worst-case scenario, against a default in names like Bank of America, getting back up to the levels that we had seen at that time, but not for all the banks. So you've seen this huge spike, which tells you investors are very scared right now, Deirdre, but at the same time, not in certain cases at the same levels that we did see in 2008.
Yeah, that's a fair point. Abdullah, do you see that as far as part of these signals that you're saying basically put us back, at least in your mind, 2.5 years ago?
Deirdre, that's correct. If we look at volatility spiking up to the 40s, if we look at just the insane intraday movements that we saw in August in equities, investors are clearly scared. And where there's fear, more often than not, it's the lead up to a big drop, sort of on the cusp of the precipice, if you will.
Abdullah, when you say at the end of the day it's a banking problem, where do we go with that? Because the banks themselves, as we found out this weekend, are pushing back against the regulators, saying that they want some of the provisions written into the Basel III Accord to be rolled back. If the banks are the problem, surely the regulators or the central bankers or the governments ultimately have to win the battle with the banks if the financial system is to recover, or is that not the case?
That is the case, but the fix it's going to be driven by a set of political decisions. And we've seen a tremendous amount of foot dragging on the political front on both sides of the Atlantic. And until we see greater political will in Europe, a move from a monetary union to what ultimately is inevitable, a fiscal union, we're going to continue to have these gyrating movements and potentially a complete loss in confidence in the markets.
All right, Abdullah, well, that's a severe warning. We are going to keep your comments in mind as we go through the trading day. Abdullah Karatash joining us there. He is head of U.S. fixed income trading at Nataxis North America.